Hello everyone, welcome to Fearfully Greedy. In today's episode, I wanted to talk to you about the least flashy and sexy form of investing. I'm sure all of you have heard of growth investing, value, index investing, shorting, private equity, all of that. But have you heard about net or have you heard about cigar butts? Today I will cover that because I added a new position to the portfolio and it's one of these stocks. I will tell you the main concept, my thoughts, ideas, main points, and all that. So what I did since the last video is buying 1,004 shares of Batla Minerals at 62.5 cents. I can already hear when I say another miner, the whoosh on the room, but it's a very different position. I will tell you why. But nothing to do with Warrior Met Call, right? Also, full disclaimer again, this is not financial advice. Please do your own research and seek professional advice before investing. Okay, the portfolio stands like this. So you can see as 5th of January, we have 9,690 euros in the portfolio. Now only 1.6 is in cash. And then the biggest position now is Warrior Met Call, followed by Biogen, then Intel, TK Tankers, Berkshire, Batla Minerals, and then Interra. Remember that I started the portfolio on 13th of July, and then I kept adding 500 euros every month and trying to deploy the capital as soon as possible, as fast as possible, and with the biggest margin of safety. Also remember, if you don't want to miss an episode and keep following the portfolio and the value investing ideas we cover, go to subscribe and follow along the channel. Now let's check the transactions on the Giro. So you can see in July, I haven't added any other position to this one, so only Batla Minerals on the 31st of December. The truth is I wanted to keep all my bad decisions on the previous year. Well, I'm joking. It's not that. I think it's a great investment. It just happened that I could get some shares on that day. It's a company that has super low volume. So I have been trying to get in for a while and not pay too much. But you can see here that at the moment is that, well, the next order it's at 59.5 cents, but the next big one is at 63. So it hasn't gone down a lot or up a lot. And I will keep adding. Like if it falls a bit, I will add more to the position, maybe on the next 500 euros, who knows. Also for now, I haven't added the 500 euros this month. It's an automatic transfer on the 15th, so it's not here yet. So let's see about that. Now let's check share side. You can see I have added already Batla Minerals, the last position, right? Since July, we kept building up. Capital gain at the moment over 1,000 euros. Total return bit under 600 because we have a currency loss of 450 euros, right? So a big currency loss because the dollar has been getting crushed by the euro, so we're getting super devalued there. I also think it looks best like this down here, so everything grouped. So you can see the return, right? Only losers, Biogen and Batla Minerals. I just bought 5 days ago, so not a big amount. And also it's super volatile. Because the price is so low, it just changes the value a lot. But if it goes down from here on the next 500 euros, I will add more for sure. Remember about the Excel, we have an Excel, you will see the link on the description where I keep updating the position, so you can enter there and check the exact position, the gain, the currency. You will see it's very, very close to the share side account. Only thing that differs is that the currency exchange might be slightly different, right? But the main idea is there, it's just some cents different. And then on today's video, let's talk about net. So net stocks or cigar butts are stocks that are trading at less than the liquid assets minus liabilities. What it means is we take the current assets, which are cash equivalents, account receivables, stock inventory, marketable securities, prepaid liabilities, and other liquid assets. assets that you could sell very quick, like in less than a year, and then we could liquidate the company. And also then you subtract all the liabilities, so we get like a liquidation value, and we compare that to the price we're paying. If there's a difference there might be some value, right? You want a good difference because these assets are taken as face value, as what we have on the balance sheet. So there's another term that is net working capital, which in that one we discount every account depending on what it is. Like if it's inventory, we might discount it by 25%, right? Or 50%, depending on the company. I will show you now a bit of the usual discount rate that we might do on these companies. But you can work with net current asset value. So NCAV is net current asset value, right? We want to pay less than that. So my main points to do this kind of investing is, first, you want to diversify being. This doesn't affect an individual pick, but if you are building a portfolio of only these assets, I would advise to make it quite diversified, right? Then the main points on each idea is that you want a big discount on net current asset value or on net working capital, depending on what you work with, but you want a big discount, like over 50%. Then the ownership structure is very important. Make sure what company owns what company owes what liabilities might be there, even outside of the balance sheet, because sometimes you have long-term liabilities that might not appear on the balance sheet. So you want to make sure, like if you're buying a subsidiary of another company, or this is a holding from 3 other companies, what company owes what and owns what, right? Make sure the ownership structure is good. So make sure. Then make sure it's not a capital structure, so not a high burn rate, that they are not issuing shares when they are below net current asset value. I would really run from this kind of companies because the value, like the money is there, but it won't be for a long time. Then big shareholders. It's important in this kind of company who owns it, because then they can decide what to do. First, if the management owns the company or a big part of the stock, I would advise you to run, right? Because they won't liquidate the company. So they have a big pile of cash that they can keep getting paid on their salary every year, and they don't have to share it with the rest of the shareholders. So they won't have any urgency to liquidate the company or extract this money from the company, right? And then so if there's a big outside shareholder, someone that is not a management and has a control share, I would say that's a big plus. So I would look for that. Those are the 4 main points of a net stocks that I think you should look for. So now let's take a look at the company I just bought, Batla Minerals, as an example. Quick overview: they are a mining company specialized in diamond mining. They own some small mines, but they are mostly a contractor. So if you want to mine your mine, you contract them and they will extract the minerals. They have a super small operation on granite. They are doing some other projects, but mainly diamonds. So that's their main thing. So the company registered in France. They are in the Euronext Paris exchange at the moment. The company holds Elnino Mining, which is a company registered there, which is the one that really operates all the contracts, right? Who is mining almost everything. Very quick overview: market cap 3.5 million, revenues close to 10 million, and the free cash flow they make is from 1 to 2 million at the moment, right? So even on this valuation, they would be a very value stock. They make a good amount of money for the price we pay, right? It's not the best business ever. I will tell you that, but we didn't buy it for the business, like the business they have. It's a good plus. It's like the cherry on top, but we bought it for the net value they have, right? So you can see here on Batla Minerals, usually I would advise you to always think in a company on absolute terms, like the market cap, the enterprise value, the debt, all in total terms, right? Not per share, because it gives you more information and requires less information from you. Because if you know the total debt, the total revenue, you have a very quick idea of how big a player on each market it is, and you don't need to, I don't know, it just doesn't add a lot to the process. But I think in conceptual terms, to explain this, you will get a very quick idea, right? So we paid 62.5 cents per share, and what we're getting? So we're getting an earnings of 26 cents per year on this company. They are not the most stable earnings, but in the past 2 years they are doing that and improving. So it's almost half of what we paid in 1 year earnings. So not bad. Then they owe nothing. So they liquidated the debt last year, so they have nothing. They paid it all off. So no liabilities in this company. Then the main point. So the net current asset value, so the current assets in this company are almost 2 euros. So that's almost 4 times what we paid for, only in current assets. So ridiculous value. And then I wasn't looking for this, but they have a very high return on capital employed over the past 5 years of over 50%, which is super high. So they are not a capital destructor. They have a lot of cash on the balance sheet, and they generate a good amount of cash, right? I said the cherry on top is that it's a business that is still operating. Sometimes the nets are not operating anymore. The business is super bad. It's declining. They are losing money and so on. In this case, they are not. And then the other thing is we have some huge shareholders that are outsiders, right? Over 85% are people outside of management. And so management doesn't own a big share of the company. The biggest shareholder, Garfield BB, is an aluminium producer in the Netherlands, and they did 20 million in revenue in 2010. I'm sure they are doing much more than that at the moment. So I don't think this is a very important asset for them, but I'm sure they are not here to lose money. The only problem is if they got on the IPO. This company IPO'd in 2007 for 15 euros, right? If they got in there, they are already at a huge loss. So they might not care a lot at the moment. Also, these holding percentages, I don't think they are super updated at the moment. So I wouldn't trust them 100%. But what I want to get from that is that there are big shareholders and no one is in management. So that's the key idea here. So well, I just wanted to present this cool concept, this great way of investing. Although please, yes, diversify if you are doing net debts. It's very important, or you have to know the company 100%, like if you own it, right? Well, everyone take care. Happy 2021. Well, I will see you on the next video. Bye bye.